Good morning, good afternoon, good evening, everybody. Welcome to our latest structured note deal launch. Our latest structured note is called the BBVA Global Bank's Defensive Autocall Structured Note with a subscription ending on the 11th of July. I am joined by Carlize Greyling, and the purpose of today is just to provide you with some insight in terms of this new exciting structured note. So I'm Riaan van Vyver, Chief Investment Officer of the Global Wealth Group. We've got two operational companies, the one called WealthPoint. WealthPoint is responsible to provide sponsors and deals on the marketplaces, and also it is the enabler of the technology or the fintech that behind the marketplaces, and then of course Wealth Migrate, which is our internal marketplace. So without any further ado, let me start off by just giving you insight into our latest structured note. I'm just going to share screen. Right. So the first thing of importance is you will see that the structured note is issued by BBVA. Now, BBVA is a Spanish bank, and you can see that BBVA has a very high credit rating. So in other words, in terms of, let's call it counterparty risk, the risk of default, we believe that BBVA has a very low risk of default, since it's a big Spanish bank, it's a big European bank, but more importantly, it's got a proper credit rating. And a credit rating is nothing else than simply an identification or a idea of a risk of a counterparty. So the next thing that I think is important is just that we are looking at global banks as the theme, or our reference basket consists of global banks. And you will note that we say that this is a defensive play. I think given the headwinds we've experienced in equity markets since 2022, as well as the geopolitical risk that we experience in Ukraine and Russia, we foresee that volatility will remain in markets for the immediate near term, let's say within the next 18 months. And therefore, we believe that global banks, by its nature, provides a defensive story to investors and to the structured note. And I think, like all our previous structured notes on the digital marketplace, you will see that this is an autocall structured note. In other words, there is the possibility or the potential for the structured note to mature before the maximum structured note term. So going into further details in terms of the structured note, you will see that the structured note has a maximum term of 4 years. In other words, the structured note will end after 4 years. There's an autocall opportunity on a quarterly basis, but the first observation of this structured note is after 6 months. So in other words, for the first 6 months, there's no event happening, and investors will still earn their return for at least a 6-month period, whereafter there will be an observation date. And an autocall is simply, if a certain predefined criteria is met, the investment or the structured note stops, and investor capital plus return will be returned to investors. Now, I think what is important is that you will see that the autocall trigger level sits at 95% of initial level. So what investors need to realize is that this autocall has a strike date of 12th July 2022. What that means is, on the 12th of July 2022, the stocks forming part of the reference baskets share price will be determined. And any autocall event or observation date, the current price will be compared to those initial prices determined on 12th July. Furthermore, this investment will auto-call when the stocks, all of the stocks forming part of the reference basket sits at 95% of the initial level. So in other words, even if the stocks forming part of the reference basket falls by 5%, this investment will still auto-call at a specific observation date. The return or the coupon is equal to 22% per annum or 5.5% per quarter. The investors will note that there's also a Great Britain pound option listed here, but just please note that through the the Global Wealth Group digital marketplaces, we will only be offering a US dollar option. So although the Great Britain pound option is listed, it's not available to the Global Wealth Group through your different digital marketplace investors. So a very attractive coupon of 5.5% per quarter or 22% per annum. I just want to say at this point, I see we've got quite a lot of participants as part of this deal webinar. If you have any questions, please post your question in the Q&A box in terms of this deal webinar, and Carlize and I will have a look and answer those questions either as it come up or at the end of the deal webinar. So a key point here then is that after 6 months, and you will see the first observation is, just want to get there, is on 13 January 2023. So this is the first potential date where there is an observation that this structured note could auto-call, and it could then stop, and investor capital plus 6 months of coupon return is repaid to investors. Thereafter, there is an observation date and a potential auto-call event quarterly up until the final observation date, which is 13 July 2026. In other words, 4 years from inception. Now, should this structured note not auto-call within the 4-year period, and at the final observation date, these stocks in the reference basket is below the 95% auto-call level, then there's a capital protection barrier that kicks in. So if the stocks at final observation, i.e. after 4 years, is below 95% of its initial level, then the capital protection barrier comes into effect. And you will note that the capital protection barrier sits at 50% of that initial level. So what that means is your basket or the stocks in the reference basket need to fall by more than 50% before this capital protection barrier kicks in. So I think a key point of this structured note is that it's very defensive and it provides high levels of capital protection or capital protection levels in terms of the note. And we will have a look at this a bit later in more detail. One other thing that I just want to mention about the, let's call it coupon, the quarterly coupon. You will see it say over here that this is a snowballing coupon. Now, investors will remember that with previous structured notes we had, it was structured notes that pay a quarterly income. In this case, with this structured note, it is not paid quarterly. So in other words, the quarterly coupon accrues, but it's not paid out on a quarterly basis. The quarterly coupon that accrues on a simple or a nominal basis will only be paid out when the structured note auto-calls, and then all previous quarters coupons plus investor capital will be payable to investors. So if we just take an example, let's say the BBVA Global Bank structured note autocalls after 12 months. It means that after 12 months, at that point when the structured note autocalls, that investors will be getting their capital back plus 4 quarters of accrued coupons. In other words, 5.5% times 4 gives us a 22% gross return. Just remember, if you look at your digital marketplace, each digital marketplace has its own unique fee or cost structure. So you can have a look at your digital marketplace for the net returns available to investors. But the key point here of the snowballing coupon is that if a quarter of coupon accrual or declaration is missed, the structured note remembers that that coupon is payable, and at the next event that this structured note autocalls all previous quarters coupons that accrued will be paid out to investors. So I just need to reiterate then, this is a growth-orientated structured note. In other words, coupons are accrued but not paid out. In other words, it rolls up until the structured note autocalls, and capital plus all accrued coupons are then paid out to investors. Carlize, I don't know if you just want to add something at this point, or are you satisfied with what we've explained up to now?
Thanks, Riaan. I think if we can maybe just touch on the 3 different scenarios that can play out. I see there is a question asking what would happen if an autocall event does not take place. So maybe just explaining what the
excellent. Yes. So I think it's a very important point. And Alex, thank you for the question. I think it's very important for investors to understand that we want this structured note to autocall. Because at an autocall event, you get your capital plus all accumulated or accrued coupons repaid to you. Another thing that I just need to highlight is that, let's say 5 quarters of coupons are repaid to investors. Remember, it's not capitalized coupons, it's simple or nominal coupons that's rolled up over the period of the structured note. But getting to the question, within 48 months, so let's say before the final observation date, if there is an autocall event, very simply, any quarterly accrued coupons that's been rolled up plus capital will be repaid. Now, let's say we didn't have any autocall event up until month 48. In other words, the final observation date. Then one of 2 things will happen. If all of the underlying stocks forming part of the reference basket is at 95% or higher of the initial level, very simply, then it sets your accrued coupons plus capital is repaid. So, Alex, option 1 or scenario 1, there's an autocall event at the last observation date, and all underlyings are at 95% or above, then all accrued coupons plus capital will be returned. Scenario 2 is that all of the underlying shares forming part of the reference basket is below 95%, but above the capital protection barrier of 50%. In other words, the underlying stocks prices sits between 50% and 95%, then no autocall will happen because an autocall trigger is not satisfied, and investors will only receive their initial capital. So because there's no autocall, no coupons will be payable, and investors receive their initial capital. And then worst case scenario is that there's no autocall, and at final observation, any one of the stocks underlying to the reference basket is below 50%. What happens then? So let's say Barclays, and we will get to the reference basket now. Let's say Barclays comes in at 45% of initial level. That then means that investors on all, or investors will make a 55% capital loss and no coupon will be paid. So that's why we said earlier that it is in the investor's best interest if this structured note autocalls and all accumulated coupons plus capital is returned to investors. Now, if we then go and have a look at the stocks forming part of the reference baskets, remember we said it's global banks. So you will see the first bank is Commerzbank AG, which is a German bank. And just by the way, we offered a global bank structured note earlier during this year, and Commerzbank is the only bank that was included in the reference basket of the previous global banks note. So for investors, it's important to understand and realize that although this is also a global bank's structured note, the stocks forming part of the reference basket is totally different to those of the previous global bank structured note, which means that investors still obtain diversification within banks as a sector or an industry. The next bank is Société Générale, which is a French-based bank. We've got Barclays PLC, which is a British London-based bank, and then Bank of New York Mellon Corporation, which is a US bank. So I think, Carlize, if we look at these banks, we can see, first of all, it is high quality. There's earnings supporting these banks. And if you look at their mere size, and we will go into that a bit later, there is a low risk of these banks not making it, in other words, surviving because of its size. So what we believe is that these banks, that the central banks, in other words, the reserve banks, if any of these banks run to an issue, will step in, and there's no systemic risk to these banks in terms of survival. Also, that these banks provide us with global diversification. As we've mentioned, we've got Commerzbank, which sits in Germany, which is based in Germany. We've got Société Générale, which is in France. We've got Barclays, which is UK British, and we've got Bank of New York, which is USA. So a very nice diversified offering of underlying banks that plays a fundamental role within their country's economy or on a global basis. And there's quality because there's proper earnings coming through. Earnings means there's dividend yield. Dividend yield means that the coupons could be supported. So maybe if I can then just go and change onto another presentation, I will explain the case for banks. So why do we, within the supply team at the Global Wealth Group, believe that global banks are still a good investment? So the first thing is that equity investors, global equity investors like asset managers, stockbrokers, and so on, typically prefer banks for their dividend yield. In other words, their income stream, rather than it being a capital growth play. So typically, stocks or equities that has a high dividend yield is defensive in nature, and it provides, by lack of a better word, support for potential downside. So you'll find that stocks or securities with a dividend yield component tend to be more defensive and more, let's call it, capital protection orientated with less volatility than stocks that's a pure capital growth play. I think a key point is that our investors would have read in the press, seen on TV, that all the central banks has stopped this financial stimulus or the cheap money into economies, into markets to support markets and economies. In other words, that means that cheap money, in other words, cheap liquidity, cheap credit, those days are over. And that is very supportive of the income and revenue streams for banks. The next thing is that all over the news, we know that inflation is rising globally. Now, central banks have been increasing interest rates to basically curb the increase or the rising inflation. That means that if there's increase in interest rates, banks earn more in terms of revenue due to the debt or the loans that they extend to their client base. So although global inflation is typically bad for equity markets, it's positive for banks, because increasing interest rates means that revenue or income streams, net interest revenue streams for banks go up, which support earnings, which support share prices of banks. Now, you need to understand, over the last few years, interest rates declined and were very close to zero levels. For example, in the US, before the increase in interest rates, if you had to put money into a 12-month money market, you would have earned 0.1% in dollar terms. And that then meant that banks didn't earn a lot of revenue by extending debt to their customer base. But now, with an increase in interest rates, that revenue picture changed. Another positive point for banks is that pre-COVID, but more importantly, within the COVID period, banks were very nervous what the impact of COVID would be on economies, but more importantly, on their client base. In other words, corporates as clients struggling from a commercial perspective, or individual clients struggling because of a cut in income, unemployment, those kind of things. So what the banks did was, prematurely, because it's prudent, they provided for a lot of bad debt within their business. So in other words, they took some of the revenue that they did earn, they park it aside to say, if my client base default on their debt obligations, I've made a provision for that bad debt. Now, with the economies coming online, with China starting to manufacture again, with potentially recession fears moving away because of inflation over the near term starting to top up and roll over, these bad debt provisions could be, let's call it, loosened, or they could be less stringent on the bad debt provisions, which means that suddenly a component of revenue that was put aside to provide for bad debt can now suddenly come back into the bank and their balance sheets, which means it provides support to the banks, their results, their income, their growth prospects, which we believe is a big, big positive. And then the fact that the current geopolitical risk or threats, Ukraine, Russia, talks about China, that combined with economic pressures, with China basically shutting down their economy due to COVID-19 threats, and the Russian impact on supply, we believe that due to these supply shortages and supply constraints, that these factors absolutely supports defensive stocks like global banks and value stocks like global banks. Remember, stocks that pay high dividend yields will be seen as a value-orientated stock, whereas something like Apple, Google, Facebook will be seen as growth-orientated kind of stocks. All capital growth, little dividend, where defensive stocks like banks have good income streams, and some degree of capital growth projects or prospects, but there is more dividend yields than pure capital gain. So looking at these factors, we believe that there's fundamental support for global banks. And this to us says there's a story that supports that coupon of 22%. So then the next risk for investors would be what happens if the stock price of these global banks fall. Now, just important that investors that invest in the BBVA global banks, defensive Autocall structured notes, do not own the stocks directly. BBVA only use the movement in the stock prices as a reference to see, are we at 95% at initial level or are we at 50% of initial level for either an autocall to kick in or for the capital protection barrier to be applicable. That's why we look at the stock prices of the global banks. So we've already shown or illustrated that there's sufficient, let's call it tailwinds for banks, that it's a good investment story, that there's good investment thesis, and that there's support for the coupons of global banks. Our next assessment then is, what's the risk to investors in terms of global bank stock prices falling more than the 5%, but worst case scenario below 50%. And we believe there's once again very good support for global bank stock prices. So equity investors, and we've mentioned it with our previous global bank structured notes, experienced serious headwinds from 2022, the beginning of 2022. We saw that global investors said, we do not want to take risk. So in essence, they decreased their exposure to global equities, which meant that the prices of global equities decreased, which meant that investors in global equity markets made a capital loss. But we believe that these headwinds experienced since the beginning of 2020 is now starting to subside or to decrease or to become less of a threat. And I've just mentioned three. So although the war, it seems, in the Ukraine, between Ukraine and Russia will continue, there's a little risk of this expanding into a global war, i.e. World War III. In other words, that there's increased global shocks, increased economic impacts due to things like supply constraints, supply chain constraints, disruptions, and so on. Also, the Chinese currency has been very strong. And it seems like if the Chinese currency will start to weaken, and then also inflation seemed to be increasing at a slower rate, which means that it could reach its top and start decreasing over the next 18 months, which is quite important for equity markets and stock prices. A key point is we've seen over the news that China was very harsh and stringent in terms of their COVID outbreak management. If they had a few cases, they would shut the country down, shut the city down. Of course, that meant that manufacturing or output by China basically came to a stop or decreased dramatically. Now, China is one of the biggest exporters of goods on a worldwide basis. So therefore, with China opening their economy slowly, it means that their production or their manufacturing will start to come online again. What does that mean? These supply blockages or the supply shortages or the supply constraints will be less. We don't think they will open the taps immediately. So therefore, we will see an increase in Chinese production, which means that there won't be a recession in China, which is very important from a global trade perspective. And then lastly, if we just use America as the world's largest economy, and we use the sentiment of US investors through the S&P 500. Now, the S&P 500 is basically an index of the 500 biggest companies in the US. And you will see during the first quarter, 79% of all companies listed on the S&P 500 index declared earnings higher than what was expected. In other words, the market expected basically compressed earnings. Now remember, earnings is revenue after tax, interest, and so on. So 80%, the majority of American companies, large cap American companies, did better in terms of their revenue and earnings than what was generally expected. And also the PE ratios. Now, a PE ratio is price divided by earnings, which is simply an indication of value. So these PE ratios came down, which means that there's now more value in the American stock market, which already provide a support for stock prices. So from this perspective, we believe that the fundamentals of banks from a coupon perspective, but more importantly, also from a support for stock price levels perspective, we believe there's enough support, a good story, fundamental support for this to be a good investment and for it to autocall within the 4-year period. Carlize, once again, is there anything that you would like to just add before we continue?
Sorry, I was struggling to find the unmute button. I think at this point, I think you're covering it well.
Right, thank you. Then, Carlize, we've got a question. Sometimes in life, it sounds too good to be true. Why can they pay such high returns? So I think the key point here is this. Why we've got the, let's call it coupon pickup. In other words, that this coupon comes in at 22% versus, let's say, previous coupons for banks that came in at a lower percentage. The key point is this. This is a growth-orientated note. So although coupons are accrued quarterly after the first 6 months, it only pays out when there is a autocall event. In other words, when the structured note stops. So therefore, BBVA, as the issuing bank, do not need to provide for the payout, the physical payout of quarterly coupons. So in other words, only when BBVA makes profit from these banks, they pay out capital plus coupons. So in other words, the risk characteristics of a growth-orientated note for BBVA as counterparty bank is totally different from when they need to pay income on a quarterly basis. So because the bank, BBVA's risk is hedged or limited to a large degree due to the growth nature, they are willing to pay a higher coupon to investors, because in essence, they will only pay out coupons if they are in the money, i.e. they make profit of their position in the banks, and hence they can offer higher coupon percentages than when it's a quarterly income paying structured note. So Scott, I hope that we have answered your question. Also, if I can just say that we've seen in general that the yields or the coupon rates on structured notes have increased since the beginning of this year in general. For example, we had a note with a technological theme, which was issued by BNP Paribas, coming in at just shy of 16% per annum. We also had a Chinese-orientated, let's call it inward-orientated note, which came in at around 20%. So there's been a general increase in the coupons. And remember, as prices come down, your income as a percentage of value goes up. So because of depressed stock prices, yields or coupons tend to increase. So thanks for that question, a very good question. Then let's see what's the problem here. Just going to stop sharing and then share again. I can't, it seems if I can't go down on my slideshow. Okay, so apologies for this. I'm just experiencing a bit of technical challenges. So if I may then, if we can just go into the 4 different banks forming part of the reference basket. And Carlize, I just want to confirm that you can see my screen. Right, so we're going to look at Barclays Bank first, Barclays PLC. So as we've already mentioned, it is a British bank headquartered in London. It operates in 40 countries and it employs over 800,000 people. It's the 5th largest bank in Europe. It's got a primary listing on the London Stock Exchange and the secondary listing in the New York Stock Exchange. Furthermore, it forms part of the FTSE 100 index. Now, why is this important? If a bank forms part of an index and you get index managers or exchange traded fund managers or passive managers, if they buy an index, automatically Barclays is included in that index. So in other words, there is a demand support for the price of Barclays because it forms part of the index. And if there's a demand support, there's less risk of excessive downward movement in Barclays share prices. And then if you look at the total assets of Barclays Bank, you will see it sits at just over 1.3 trillion British pounds. So we are looking at a big, large, top quality bank in Barclays Bank as one of the underlying stocks forming part of the reference basket. Commerzbank, as I've mentioned before, It is the second largest bank in Germany. It's headquartered in Frankfurt, but more importantly, the type of services that Commerzbank provides to market means that it forms part of the backbone of the German economy in terms of infrastructure spending, corporate clients, and so on. And you will see that the total assets of Commerzbank based in Germany is $658 billion US. Once again, big size, high quality bank. If you look at Société Générale, which is a French multinational investment bank and financial services company. Now, the key here is Société Générale is diversified. So in other words, it's not only banking income, but there's asset management income as well and financial advice income as well. So here we're getting diversification from a revenue perspective, which is quite important, again, for supporting our coupon, but also supporting the prices of Société Générale. You will see that Société Générale is the third largest bank in France, and by market capitalization, it's the sixth largest bank in Europe, and it's the 18th largest bank in the world. And once again, as per Barclays, Société Générale forms part of the Euro Stoxx 50 index. So once again, it forms part of an index, and if asset managers buy the index, Société Générale is automatically included in that. So if there's buyers, it supports the price of Société Générale, which once again limits the potential for a significant downfall or decrease in the price of Société Générale. And you will see their total asset sits at 1.811 billion euros. Once again, big quality bank. And then lastly, Bank of New York Mellon. You will see it is an American investment bank. It's headquartered in New York. And important, it forms part of the Fortune 500 list of companies. So it's established, high quality again, and the total assets of Bank of New York Mellon comes in at 2.2 trillion US dollars. So I just want to reiterate that our basket, our stocks forming part of the reference basket is quality, big in size, which means that we've got support from the central banks. There's diversification, and there's geographic diversification in terms of Germany, France, UK, and the US. So at this stage, I think that concludes our presentation, our deal webinar. I don't know, it seems like, Carlize, if we have answered all questions. I don't know if there's any of the participants that still have a question. We'll just give it a minute or so for the participants to ask questions. But otherwise, we've concluded our presentation. Okay, excellent. So we've got another question. With the, let me just opening it up. With the world capital moving more and more towards organizations focused on improving their carbon footprint, ESG, are there any banks within this basket that are future thinking? So, Alex, I think in general, the question or the answer is that if a company is listed on a stock exchange or included in a index, a global equity index, there's certain guidelines or minimum requirements from an ESG perspective. So the answer is yes, most definitely, because of the profile of these banks, ESG would form part of their business model, if not by own design, but due to the requirements of being listed and or included in global equity indices. Carlize, are there anything that you just want to mention or add before we finish off?
Yes, Riaan, I think there's just a few closing comments. Just want to highlight the strike date of 12th July, which is in about 2 weeks. And also just noting that investors will note that this specific structured note does not have an income trigger. So I'm not sure if you do want to just mention. So it will basically just continue to accumulate coupons until it does autocall. And then just getting back to the autocall and the 3 scenarios, I think it's just important to highlight that a structured note is a fixed agreement with this large bank, with BBVA. And so you're not, as Riaan mentioned, you are not owning these physical stocks, but these notes are designed to autocall. So there's a very low probability of them actually not autocalling. Even looking at past structured notes, most of them did also autocall. And just looking at the 3 scenarios, the first scenario, if it does autocall, you will earn the very generous return of 22% per annum coupons that accumulated, as well as your full capital return. In the second scenario, you will not earn any coupons, but you do earn your full capital return if it reaches the final observation after a 4-year period. And it did not autocall during that 4 years. And then the last scenario, where you do not earn any coupons and your capital is reduced, that is a situation which is similar to investing directly in the stock market. And because these structured notes are generally less risky than investing directly in the stock market, because they are fixed contracts, it will only play out in that scenario where it looks like you were directly invested in the stock market, where the level fell to what your capital would be worth. And for instance, if it was a non-dividend paying stock that you invested in, then no coupons would have been earned either. You would also receive only that portion of your capital back. So in that scenario, which is a very rare chance of happening, that is the worst case. But other than that, I do think this is definitely a lot less risky than directly investing in a stock market, as it is a fixed debt instrument by a very secure bank with a good credit rating.
Carlize, thank you. So just on that point, I think as part of the fact sheet, which the investors will be able to see later this afternoon when the deal goes live on the internal marketplace, there's an indication of recent stock market price movement. So if we look at Commerce Bank, you can see from its speed, we've got a gradual downward moving line. So in other words, that capital protection barrier is at already depressed share price levels. If you look at Societe Generale, same story. From 2017, a downward moving price line. Barclays, slightly downward moving price line, and Bank of Mellon, also a downward moving price line. So in other words, these banks forming part of our reference basket already have decreased or depressed share price levels. And then we've put the initial or our initial levels in, which means that we've got initial protection plus further downside protection. And given the fact that we've got fundamental supporting the banks, as we've explained, we believe that that last scenario is highly unlikely, and we feel confident that this structured note will autocall. And it's also just important to note that IDAT, for example, since 2020, had 4 global bank structured notes, which already have autocalled. So in other words, the basket or the stocks forming part of the underlying basket are specifically selected for this autocall trigger or the autocall event. So then it doesn't seem if we have any more questions. So from my side and from Carlize's side, this deal will close on your internal marketplace for funding on the 6th of July. So to all the sales teams, the wealth consultants of their marketplaces, the deal will be live on platform from this afternoon onwards. which is today, the 27th of June. So please reach out to your clients, please reach out to investors that we have this fully funded by the 6th or the 7th of July. It is an exceptional good investment opportunity given increased volatility since 2022. So thank you very much for your time, and we look forward to welcome you as investors into the BBVA Global Bank Defensive Autocall Note. Have a good day. Bye-bye.